Awesome. Okay, great. Well, I am glad to have Ben Slome of New Vintage Partners with me for a little Random Walk conversation. Today's topic is been a recent topic that's near and dear to Random Walk's heart, which is the secondary market and secondaries more broadly. Just really quick recap. Obviously, there is a recurring theme in the stuff that I write about is the no exits for private capital, which is extends to private equity, but also venture in particular, although really, frankly, both. And so the traditional off ramps, whether through public markets or M&A, company-led M&A, or even sponsor-led M&A, have not provided the liquidity that these asset classes have generally come to expect. And secondaries have risen in status and in opportunity as stepping into that void. There are obviously some. I guess there's some overhang there in terms of whether or not it's opportunism, whether it's really going to be a meaningful, unlock for the liquidity in the ecosystem writ large, or it's really just sort of opportunistic stuff. But anyway, that's why it's interesting. And so I'm glad to have Ben Slome of New Vintage Partners, which is, well, I'll turn it over to him to sort of describe what it is and what they're doing. But suffice to say, it is secondaries focused. So thank you, Ben. And why don't you take it away, just describing a little bit about what the fund is doing, what the strategy is, how you got there, and how long you've been at it for, and we'll work from there.
Sure. Well, first of all, Moses, thanks so much for having me on. Excited to be here. I'm a religious reader, and so it's a pinch yourself.
I like sacrilegious readers.
Sacrilegious readers in spirit, but always a pinch yourself moment when you get to participate in a medium that you consume as part of your information. So thanks for having me be here. So really high level, a little about us. We founded the firm in June of 2023, just over $200 million of AUM. We focus predominantly on secondary LP stakes in mature venture and growth funds. Really the reason and the genesis for that was in a prior life, both mine and my partners, we saw a gap in the secondary market that frankly had been born from a maturation, as you mentioned in your opening remarks, of secondaries, and they've become very, very large. But the dynamic is such as the capital has aggregated itself in really two handfuls of the players in this space that build indices of private markets by deploying tens of billions of dollars every 4 years. And venture and growth was really seen as just an afterthought. And we saw that price and risk were really mismatched. And we decided to start looking for opportunities in the space on a deal-by-deal basis and found that there was a real opportunity to build an institutional business that prosecuted that chasm between risk and price.
So just to back up a second, first of all, two things. One is like you started this in September 2023, which is, I think, generally speaking, before I would say reality set in on the industry that secondaries were going to be increasing part of it. So talk about a little bit about that, like how you sort of came to the conclusion fairly early. And then I think too, is I guess what you mentioned before is just that, where secondaries, you refer to indexing the industry. I assume you're talking about secondaries pre this turn, right? Like, but maybe I'm wrong, but like dig into that a little bit more. What does that mean? And, who are the representatives of that?
Sure. Yeah. So maybe let me take that second question first and I'll come back to how we jumped in. Really, and this applies to any sort of money management strategy, which is the larger you get, the less time and resources you have to underwrite things from a very fundamental basis if they do not meet a certain opportunity of deployment. What I mean by that, a lot of words, if you have a $50 billion fund, you don't have the time to look at a $50 million transaction. You need to be deploying instead of $500 million.
Huge chunks.
Right?
Yeah.
And that opportunity set lends itself to going and purchasing in areas where you don't need the same level of scrutiny that you do in our market. And what I mean by that is what traditional venture and growth, traditional secondary players do is they're buying enormous LP stakes and GP-led positions from folks that are in KKR and Blackstone, that those funds themselves are 30 or $40 billion private equity funds. And so the stakes in them are really large. And the core and the concept of what I'm really starting to open up is when you're buying a 15-year-old or a 12-year-old or name your vintage fund where the underlying fund, where the chemical businesses or industrials businesses, and they've been around since 1945 and they have 50 years of audited EBITDA financials from one of the big four, the marks that the managers, KR or any of those large managers give you are pretty reliable within a pretty tight confidence interval. When you go to venture and growth, we politely say that NAV is a fictitious concept. We often see the same asset, the same company in different portfolios, and the marks are 3 orders of magnitude different. And so when you go to venture and growth and apply that we buy everything at a certain price is a really good way of getting yourself into trouble and impairing capital. And our job is really to understand truly what intrinsic value is at the company level. So going from the bottoms up, company by company, underwriting them as a more traditional value-based investor would underwrite them. So EBITDA multiples, cash flow multiples. We really don't talk about revenue multiples in our investment committees, right? So, and we just understand what the intrinsic value of those companies are, and whatever that buildup of value is that meets our underwriting and return hurdle is the discount. And that's a very different philosophy than I think a lot of other secondary players apply to this space. So that was a long way of answering your question.
Yeah, no, I think it's helpful, and I think just one point of clarification, then a follow up. So, like, first of all, you're buying, an LP, say an LP stake in XYZ fund that has these 20 positions, or are you buying, whatever, a stake in XYZ company that's been private for a while, or both?
No. We're buying LP stake in Fund 4 of XYZ Fund. And if you think about what the strategy in venture and growth is NAV sort of looks like is flat, right? They make 30 or 40 bets. And by year 5, 10 of those bets have been 0 written off. By year 7, you really have 1 to 5 assets that are your fund winners. And these are, by the time that we are looking at them, at scale, many hundreds of millions of dollars of revenue, if not more, significantly profitable, and equally important for our strategy, as we're a 5-year fund, not a traditional 10 plus 2-year fund, so liquidity is really important to us. They're in the life cycle where liquidity is really on the horizon. And how we price what we buy is we look at companies that represent more than 5% of NAV. And that is generally, as I've said before, 1 to 5 assets that represent 80+% of the NAV. And then there's 10 to 20% consist of the companies that are good companies. They just weren't the breakout companies. So they're maybe the ones that you get your money back, or it was a 2x return or even a 3x return, which if you're the venture fund, those are kind of like your failures. But for us, we're often not paying for those. Those are just option value. So even if you get your money back or even 80 cents on the dollar for those, that's where the convexity of our returns come from.
So it's interesting. So basically, you're not underwriting, you're underwriting 4 or 5 names in anybody's book. You're not necessarily underwriting all of them.
That's correct.
I'd
need a team of 200 if I wanted to do every single company,
right,
every single portfolio. But it's really, sorry, not to interrupt you, but this is just an important point. For us, it's just so critically important because of what I said before about NAV and not being able to really trust it. You really need to understand those 1 to 5 companies at an excruciatingly deep and detailed level to know and feel confident that you're buying value. Because what I'm really doing, if I'm going to simplify, is I'm really trying to buy $1 for 60 cents. I hope that dollar goes to 120, 130, maybe 140, maybe even $2 if things go really well. But what I'm really trying to do is make sure that dollar is worth at least 90 cents. So I make my money on the buy, and that's critically important.
Yeah, you have some of the expensive discoveries been done, right? So you can sort of de-risk it a little bit, and then rather than you're probably looking for more normally distributed returns over a shorter time horizon, like higher batting average, lower slugging percentage. So how many companies are actually in scope here? Are we talking, like, in other words, you say, you're looking at the top 5 companies in anybody's fund. Like, what is the universe of those top 5 companies? Is it 10 companies? Is it just like SpaceX, OpenAI, and a handful of others? Is it 100? Is it 1,000? Like, how many are we actually talking about?
So this is a good question. So what does the market look like? In the past 18 months, we've seen about $60 billion of LP volume. And that was volume sent to us because for whatever reason, it had some elements of it that might have fit our strategy. About at least 50% of that is sort of dead on arrival, right? Kind of too young, the quality's not there, for whatever reason. We have a fancy funnel that has a lovely graphic that tells you how we cut that down. But basically, from that sort of 50 billion, roughly 2 or 3 billion of that has been of a quality and sort of makeup that we would consider of premier assets. And so those are anywhere from sort of however you want to cut that up and divide it by number of companies. But you can kind of think about it more of there's $2 to $3 billion every 24 to 36 months of exceptional quality product that would meet our underwriting.
Interesting. So it's not like you're just, or maybe you are, and maybe I'm pushing on it too hard, but like in others, you're not just immediately cracking open the tape and saying, okay, do you have one of these 10 names? If not, correct, move along. Yeah.
That's correct, right? There are companies in our portfolios that are the largest companies you've never heard of. I'll give you an example. Kaseya. You might, if you're a basketball fan and you live in Miami, you might know it because they just took the naming rights of the Heat Stadium away from FTX. They are the world's largest multi-service provider. So they give IT services and cyber services to small and medium companies. They do $2.5 billion of revenue, growing 30+%, incredibly profitable, right? That's not an asset that people are like Anduril or XAI or SpaceX that people are clamoring to get into SPVs, but it's just such an incredible business. Assets like that.
Interesting. Yeah, that's true. I've never even heard of them. And I guess, so then what's the profile of the seller in that case? They've just been in the position for 10 plus years, or they have other liquidity needs, or like, why would they sell?
Yeah. So we buy from what we call non-financial sellers, people that are managing their liquidity for systemic reasons. That could be a new CIO has come into the system and wants to raise cash from the old CIO and redeploy in his or her new strategy. A teacher's pension has decided that their private exposure is out of their targeted portfolio mix, and they want to reduce private exposure. So who are our sellers? They're the large pension funds, endowments, foundations that have been systematically allocating billions and billions and billions of dollars over the last 20, 30 years. And 95% of what they bring to market is the traditional large cap private equity, infrastructure, real estate. And then on page 9 of the 250 line items that they want to sell is their venture and growth exposure. And that's where we focus in on.
And do you buy just one fund, or do you have to buy it all? Like how does it go? How does it work typically?
Yeah. Listen, every process is idiosyncratic. We have looked at large portfolios in which we pick the 3 that we really like, and we bid on those. We work with private and large platform style managers and go through their portfolio and say we like this one, and this one, and we help manage their liquidity and purchase it from there. It's idiosyncratic. What I would say is, as a more blanket statement of how we approach the world, is we're not large portfolio buyers because we want to just cherry pick the highest quality. And the highest quality is exactly where you need to be in the venture and growth secondary world. Because I'm sure you've heard the term zombie corns or zombie funds, and there's a lot of landmines in venture and growth, even in the mature stages, which is why it's just so critically important.
So when Yale goes to market with their privates portfolio, is that something? My understanding is, like, both reading and just hearing some, like, they were very much taking an all or nothing kind of approach. So is that something? Did you look at that, or is that to the extent you're able to talk about it, or is that just like out of scope because that's the sort of mega buyer that you avoid?
Certainly not out of scope. We did look at it. We participated in that process, and those are the types of processes where we do participate and try and find areas where there are particular spots in that portfolio that we can be a solution for.
Interesting. Do you find, like, is this process like, of the endowments and institutionals sort of rotating away, is it speeding up? Do they feel like they're doing it because they want to or they have to? Has it changed at all, or is it like in other words, the industry story is it's like, nah, this is just strategic realignment. We're overexposed. We want to, but we're not in any rush. Whereas you could read between the lines and say actually, there's a catalyst underway, which is the endowment tax. The gravy train is ending, et cetera, et cetera. Like they actually. They're less in the catbird seat than they want to let on. I don't know what's...
Sure. So it's very interesting. When brand names like Yale and Harvard employ the secondary market, it certainly paves the way for smaller institutions to feel comfortable doing the same. So that was, when we look back on the evolution of the secondary markets, I do think the Harvard and Yale endowments will be part of the inflection point. What I think is really happening, and this is my opinion and our firm's opinion, is the secondary market before, in the last 10 years, has really been seen as a pressure valve of, I need liquidity for whatever reason. There are these kind of on-the-side firms that traffic in this stuff, and we can go to them, and we're probably going to take a big discount, but c'est la vie, and we want the money now. What you are now seeing, and you see it in some of the primary venture funds, is you are seeing that the primary venture structure and growth structure and even private equity structure documents are elongating the fund life. So the traditional 10 plus 2 year extensions is now becoming these are going to be, we're telling you, these are going to be 15-year funds. And so the secondary market, in our opinion, is moving from a pressure valve, nice tool to know exists, to a bona fide shadow capital market in and of itself, where investors can now feel a lot more comfortable deploying primary dollars into private equity, venture, and growth funds, and knowing that along the way, there's actually pretty predictable pathways and off-ramps to get liquidity from. And so you mentioned, like, why are these people selling? Often the funds that we buy are somewhere between 1 and 2 times DPI. So the investor has already gotten 1 or 2 times their money back. Even at a discount, they're getting another turn or a half a turn of their capital. When you're at a large endowment, you're not trying to get 10Xs. You are trying to generate real returns after tax and after inflation to grow the capital base. They're 100+ year capital bases. So for them, they've got a phenomenal return from this. It's more important that they recycle the capital and find new ways to generate that type of return.
Yeah, it's interesting. Do you have a sense, it's sort of like one quick question, then I'll move back to something else, but like, do you have a sense of what they're, so they're selling these, what are they doing with the money? Like, where are they redeploying it?
Moses, I can't comment on that.
I'm just sort of curious. It's like, everybody sees it as every asset manager sees it as their unlock to fundraising. Is like once people delever from,
What I will comment on, and this is anecdotal, just, we talk to LPs both as buyers and as stewards of capital all the time. What I will say is there seems to be a real shift in sentiment away from allocating to these mega platforms. Because really, when you look at the returns from a lot of the large platforms, they're index-like. And when you marry the index-like return and the illiquidity that you get, I'm not necessarily sure you're getting paid enough for that illiquidity anymore. Where the alpha is in the smaller funds that are more focused and frankly more nimble and able to be flexible in deal structure, deal sourcing, and pricing is where the real alpha is generating. Now, that obviously creates problems for people who allocate billions of dollars a year because it's really hard to do that across a bunch of different funds. But just anecdotally, it is what we hear from the LP community.
It's interesting. You mentioned structure. Do you find, like, I guess what have been some of the barriers to getting deals done? Like, in other words, I've heard various things from actually the GP blocking blocking a sale or running closed processes where they only let existing LPs come in. Sometimes structure is an issue, or like it's hard to get visibility on what the waterfall might be, or there's a lot of preference on top of it, so price is a little illusory. Do you see that stuff, or is it more formulaic than that?
Listen, every deal, because of the industry that we are in, every deal is idiosyncratic. Every seller is different. Every process is different. Every fund manager is different. Deals get done and don't get done for a number of reasons. We think simpler is better all the time. How we think about downside protection is buying premier quality assets at really, really good prices. Single digit to low double digit EBITDA multiples for companies growing 50+% and highly, highly profitable. The world has to go to a really bad place to significantly impair capital when you're buying things. It can, of course, but your downside protection from a MOIC perspective is there.
Why aren't those companies exiting though? Like if you're growing 30% and you're profitable, why can't you find a buyer?
Well, this is a bit of a can of worms, but it's too umbrella of a statement to saying why are these companies not selling. You need to segment between what these companies are. So 7 years ago or 8 years ago, if you were a software business doing $300 or $400 million of ARR and still burning cash, there was appetite for your stock in the public markets. That's no longer the case. So the IPO markets are really now only reserved for the must-own, megally scaled assets. Assets like Revolut, assets like Databricks. I would assume Anduril will get to that place. They've just gotten so big and there's so much demand for liquidity that private routes of financing just don't really work for them anymore. And there's a couple of exceptions, right? Stripe has very publicly said they never want to go public, and we could have a whole discussion on that.
We don't need it, yeah.
Right? That cohort of companies is actually a very small percentage of the assets that we look at. Where we have generated most of our realized cash returns that we've returned to investors has been from companies that are in the sub $10 billion enterprise world. And if you narrow your focus to that part of the private markets, both from strategics and from large cap sponsors like the Thoma Bravos or the Silver Lakes of the world, where my former partner was an early employee at, has actually been very active. And I'm by the way, I want to be clear, I'm sort of talking pre-tariff wars, where I think everybody's taken a little bit of a step back. But really, if you look at that part of the market, liquidity's actually been pretty active. And so I think it's really easy for people to say, like, why have there been no exits and there's no IPOs? And it's just about sort of framing the conversation. And that's why we really love LP stakes, is not only do we get to buy incredible companies, of which some of the names that we've spoken about that are the really exciting, big must-own assets are in, but they also consist of these super profitable, still healthy growing assets that sit in this world that are actually pretty active and pretty liquid, and where distributions do come.
Yeah, it's interesting. I mean, like, I've had a line for a while, like, the IPO markets are wide open. Like, if you're growing and profitable, public markets will take you. They're just, the problem is not the public markets, it's the companies that people have. And I think, some of that's been borne out lately, which is just like, there's been a run of IPOs and they're all down rounds. Which has been my point, is like, look, if you're willing to, a more reasonable valuation, then you can find, and you have a good company, like, you'll find public market investors for it. But
that's correct. Yeah. And I think, there was an article that came out, and we speak about this in our quarterly letter, which I'm happy to share with you all and your reader base. If you look at how many companies in 2021 raised at over $1 billion valuation, sort of unicorns, it's something like, don't hold me to the numbers, I don't have them exactly at hand, but directionally, something like 23 or 2,400 companies in 2021 raised at over $1 billion valuation.
Yeah.
Since then, 6 of them have gone public, and only 250-ish have gone on to raise at rounds higher than their previous. So
more than I would have thought, yeah.
So everybody loves to write about and listen to and look at the unicorn status companies, and that cohort of the world has really gotten hit hard. and for often good reasons. They probably shouldn't have received that type of funding. It's really just about framing the way you look at the private markets. And for sure, like, has liquidity come out of the system? Have exits and DPI been anemic? Yes, of course. That's why I have a business. And that's why the secondary markets are so important. But it's about...
Do you find, is it, so I've heard a few different things, like in terms of like what the competitive dynamics in secondaries are. And partly that's because like they're almost like, there's sort of, one strategy is almost like rescue money, or not rescue money, but buying things at a discount. Another one is just like, duration mismatch, where it's a good asset. It just needs a little bit more time, and the first investors want to get out, so it's less of a value buy as it is a timing thing. And then there's, of course, like, thing three, which is like, the OpenAIs and the SpaceXs and the Stripes of the world, which are actually premium buys. It's just, they have no reason to go public, but to buy in, it's actually a seller's market there. Like, do you have what is the current dynamic? Is it a seller's market? Is it a buyer's market? Are people, do you get are you a price maker, price taker? Like, what is the dynamic right now?
Yeah. Again, framing question. If you are trying to buy shares from an early employee or trying to get cap table shares of one of the premium assets that you just spoke about, you are paying massive premiums. If you are indirectly getting exposure to some of those names through LP stakes, it is a buyer's market. And that is one of the reasons we really like LP stakes, is because it is a part of the private financial market which is very difficult to access. It's difficult because it's really hard to underwrite this stuff and get the information. It's difficult because, as you alluded to before and said before, you have to get GP approval, so you need to have that network. And thirdly, it's really difficult to get the supply. There's 2 to 6 players, however you want to sort of look at it, that really control the supply in this market. So it is both a buyer's and a seller's market, because demand for premium assets and just high quality assets always trade at premiums and always trade tighter than, that's just it ages. I think what you said, and I want to bring up a point you had mentioned just before, which is a mismatch of duration of capital. That has been one of the greatest drivers, in my opinion, of the secondary market, where these funds have just been mismarketed. These funds were never 10 plus 2-year funds. These were 15 plus 5-year funds. And why? Because it takes that long to build a really good business, right? Everybody looks at the Airbnbs of the world and the Facebooks of the world, and they're like, man, that happened so quickly. But if you actually look at the history of these companies, they're like 17-year overnight successes. And so it's just a mismatch of duration, and then taking that concept one level deeper. How do endowments and endowment style managers think about deploying capital and creating a portfolio? They have actuarial tables where they allocate across a number of different asset classes, and they have actuarial tables around when the cash flows from each of those assets come. And what has happened is those actuarial tables shifted to the right. So 10-15 years ago, what they thought were going to ultimately be self-funding portfolios, which essentially, what I mean by that is the investments from one side enable you to go and reinvest and redeploy, don't come. You've overcommitted yourself, and you are getting fresh capital calls from investments that you thought were going to have generated the cash to meet those new capital calls. So you've just had a shift. So the duration of capital is an incredibly important concept to understand when thinking about the secondary markets.
Yeah, it's interesting, and it's like, in some ways, like, sometimes the objection, it's not really an objection, but you hear LPs, like institutional LPs, talk about it. It's like, look, they don't want to exit a position. They just want it to continue. They want to continue compounding their money, right? So they want, as long as there's still runway in appreciation of the asset, they're happy to be in that asset, unless for whatever reason they need the cash. But their goal is not to need the cash; it's to continuously compound their capital. So it's like, so their view is, what they'll say is like, actually, look, as long as there's still upside, we don't want anybody to sell. And I guess part of the dynamic is, in the past, is just, I don't know, I guess when companies would hit a certain point, then they would go hit the public markets. And at that point, the theory is not that there's no more upside left in the right? In that case, they could hold on to, they could get their equity and just keep it in the public markets. They don't have to sell then too, but they kind of did anyway. So I don't know. That was a little bit of it's a bit of a ramble. It's like it's a weird. On the one hand, they're saying, look, as long as there's upside, we want to be in it. But on the other hand, like that's not historically necessarily what they've done. Like there was part of what's changed obviously is okay, sure, for some companies they will just stay private longer and it just takes longer to build. And if the appreciation's happening on the private side, then that's where you want to be. But some part of it also clearly seems to be right, as you said, like they're just staying illiquid for longer.
Yeah.
And that's not that's not meeting the liquidity the profile that they modeled for when they made their prior commitments and things like that.
Yeah. Yeah.
What is, I guess, a few questions. So this is going back to, this sort of goes back to the thing that we had, like around, how did the strategy evolved in 2023, which is pretty early. So what's the story there? And the sort of second question is like, obviously it's a very difficult fundraising market for GPs like yourself. So how has that been for you? And like, how are LPs responding to this? And like, where do you find, right? Because for the same reason that all of these institutionals are over allocated and illiquid, that must also be a challenge. It's also be a challenge on the fundraising side. So yeah, I guess like
bit of the catch-22 of our business, right?
Yeah.
So what's the story? How did we get here? I was working at a family office, endowment-style family office, very similar, honestly, in profile, both from a size and just kind of sophistication perspective of the type of people that we buy from. There was a strategy shift at the family office, and they wanted to subcontract out the management of what we called the active passive management, just the endowment style of the business. So I went around and looked for a bunch of OCIOs, outsourced chief investment officers. And as a carrot to bring fresh capital to one of those platforms, they offered us an opportunity to what I would now call a secondary opportunity to purchase one of their large French insurance company clients was looking to do the opposite of what we were looking to do, take capital back into their system to manage it themselves. And that was a many hundred line item portfolio, of which consisted of large cap private equity all the way to emerging manager exposure. And we went around to every secondary player to help us price and structure and understand how to diligence this. And it just became clear that there was a really institutional approach to traditional secondaries and a very non-institutional, just price it for 20 cents on the dollar or take it for option value. So that was kind of my scratch in the head. I met my business partner. Our sort of families serendipitously have actually been in parallel, had a mutual friend for many generations, grandfather all the way down to Charles and myself. Charles came at it from a very different perspective, but equally sort of insightful and relevant here. So he was on the public side, where he was really a pioneer of block trading in the public markets. A large sponsor would take a company public, they'd have $1 billion of shares. It's really hard to get liquidity from $1 billion of shares, owning 40% of a company.
Just open up your Merrill account and put a limit order for 1 billion shares.
Right. And so Charles really was one of the pioneers of doing bilateral trades with sponsors to help them manage liquidity. So he would buy $200, $300, $400 million blocks directly with the sponsor, off market. And so there wasn't that issue of a seller, the sponsor, either needing to take 8 years to kind of trickle out of a position or try and dump the stock, which frankly would kill the price. So Charles had billions and billions of dollars of reps with every sponsor you can ever imagine. And I had been an allocator to all of those sponsors as well. And from his perspective, in 2021 and 2022, after the Rivian IPO, capital markets shut down. And he started getting phone calls from a lot of these sponsors saying, hey, we need help generating liquidity. Can you help us? And these were names that, and I'm going to leave the names out of it, but these were names where you'd put the phone down and you'd say, why are they calling me for help? These are very sophisticated, very well capitalized, very well known. And so he and I just started a dialogue around really more from an intellectual perspective. And then ultimately, as we did more work together, just decided that it was irresponsible not to start a business. To really, if in all honesty, I am more interested from a business perspective around solving problems. And this was just really an issue that, frankly, the family office that I had come from had gone through, and that we knew a lot of other investors had gone through, and other GPs were struggling to create liquidity, and they themselves needed avenues to do so. And so we saw this as an opportunity to do some problem solving in the venture and growth ecosystem. And better lucky than smart, right? Because I think we sort of started this business at a point in time where it is getting the sort of institutional attention that I think it deserves, and frankly will prove out to rightfully deserve. But I'd be lying if I said we sat around the table and hey, we see where this is going. We just saw a really big problem, and we went to solve it. And we've been very fortunate. We have a wonderful team around us of institutional quality people, and yeah, we feel very fortunate to be here and doing what we're doing.
How has how is
Sure. Yeah. Listen, fundraising is a difficult period. My business partner Charles says there's always money for good deals, and we've been very fortunate to find very good deals. So we've been successful in fundraising, and we're still early in our process. We've only really started deploying out of Fund One. We're at $150 million of capital deployed, and the results and the DPI has been really strong in the 18 months that we've been around. So we've been fortunate to have some early success. Raising is difficult for anybody. Being a first-time fund, there's a lot of structural hurdles you need to get through, but we have a lot of institutional clients and partners which have been really supportive, and we're really grateful for that. So we continue to find success, but success is not easily come by.
Do you think, are you running like the same playbook, just longer and harder than the past, or has it changed? Like, are you looking more at family offices or non-institutional or insurance, is it just kind of the same drill, just that much harder?
I think so first and foremost, I designed with Charles, we designed this business for people who understand the frictions that have come between LPs and GPs and liquidity. And we designed this business and structured it in such a way that provides private market access in a much more liquid and less volatile way. So we're a 5-year fund. So when we go to people like family offices and institutional allocators that have had the problems of being stuck in funds for 15 years, and they see the DPI that we've generated, and they see the structure and how we align ourselves with LPs from a fee perspective, we're well received. And I think it's just been a differentiated offering, frankly. Having been an allocator for 10 years professionally, we designed it to be as such. So we haven't gotten your crazy yet.
Yeah, I was just curious. How has it, I guess, changed or evolved or otherwise different from your expectations, either like the deals that you're seeing, the dynamics in the market? I'm sort of curious. Things always, right? It's not even the Mike Tyson line, like, everybody's got a plan until they get punched in the face. It's like whatever plan you set out with, it always evolves. I'm just sort of curious, like where you see the big, yeah.
Yeah, no question. It's a good question. I think I've been surprised by how quickly, I've been surprised by how quickly when we came out into market, how quickly people started picking up the phone and calling us. I always sort of thought that it was going to be really, really hard to find deals. It's not been hard to find deals. Getting deals done is hard. And I think that, the speed at which we've received inbound, I think has been more surprising. But getting deals done is a tough job, and it should be a tough job, right? Good deals should take time and should be done properly, and that's not a swipe of the pen. But yeah, I think the surprise has been the amount of flow and the amount of opportunity.
It's interesting. So, like, in other words, you're getting tons and tons of deal flow, but maybe the conversion rate is not necessarily what you thought it would be based on the amount of opportunities there are? Is that what you're saying?
No, my conversion rate's exactly where I wanted it to be. Our conversion rate's very low. If my conversion rate's really high, it means I'm not doing enough work or we're paying too much. And we are happy to miss because we maintain discipline on price and structure. Because our job is not to hit 10Xs. Our job is to consistently hit a net 2X every 5 years with cash flows along the way and generate really attractive risk-adjusted returns for our investors that look like a compounding private access.
Interesting. Okay, and then I guess just in the last couple minutes, like, is there, if you had a magic wand, like in terms of where you see gaps to fill in this space, either data or service providers or infrastructure or software, like what would it be?
I think there's a massive opportunity in the institutionalization of what sits behind primary allocators in venture and growth. And that has many different forms. There's only a very small handful of GPs that are able to access liquidity for continuation vehicles. There's only a very small handful of GPs that are able to access liquidity solutions for themselves, whether it be a NAV line or a GP commit capital call line. And there is an amazingly large, wide, and deep community of really great venture and growth investors that deserve the attention of liquidity providers. And so if I could wave a magic wand, I would love to be able to do all of that today. But we continue to build our business day by day, and most importantly, person by person. We have a great team around us. We're very selective, and we spend a lot of time with the folks that we look to bring onto our platform, because we want this to be the last place anyone ever has to work. And we have a long and deep roadmap to address that magic wand that I just spoke about. And so we're excited to go and do that.
So it's interesting. So it's like, in some ways, like secondaries is the first move, and then there are these other capital products that you can layer, like whether it's, as you say, NAV lending or call lines, but just at what would be sub Goldman scale.
Yeah, whatever it may be, we see New Vintage Partners as a real platform that will have a number of solutions that are equally as important and helpful for LPs and GPs.
Okay, last question. Do you find that you have any particularly contrarian takes on anything, on like either AI or AI, SaaS in the world of AI, or some other, like, the new industrialization plays, lending against GPUs? I don't know. Name your pick.
Moses, the joke I make to people, because we get questions all the time about, well, what do you think of AI, and are you going to buy AI?
AI for or against? Yeah.
The joke that I kind of make, and it's I say it in jest, but it's really true. Like, we are a backward-looking entity. I am not the guy to tell you who's going to win the AI war. But in 6-7 years, I'm going to tell you where the winners are, and we're going to go buy them for the best price you can get them in the market. My contrarian view, if you can call it contrarian, is I think, if you are not a massively scaled allocator that has legions of analysts and resources to go and scour the world for every best manager, you need to find a way to get access to the premier quality private market managers at shorter duration and less volatile ways. And I think secondaries, whether it's us or whether it's some of the other platforms out there, of which there are some ones that we think very highly of, because otherwise I think you're going to get yourself into a lot of trouble and look back in 10 years and say, man, we probably shouldn't have done that AI layer company or invested in that Fund 1 seed manager. I think it's just really competitive as an allocator to find differentiated alpha in private markets.
That's interesting. I think this is great. I think you're up to something really interesting, and I kind of agree. Like, I just think the infrastructure in the secondary market is got a lot of runway to build and evolve. Is just given the incentives for companies to stay private longer, how much has been allocated to privates, and how few, how rigid the off ramp has been, which is just like big acquisition or IPO. And if that's clearly there need to be more tools and more connectivity up and down the market. I would think.
We agree.
All right, man.
Thank you so much for having me on. Appreciate it.
Thank you. All right.